All right. Well, it's just about 10 o'clock, so I want to get us started. I'm Ann Smart. I want to welcome you to the Loyola Family Business Center webinar. I am the director of the Loyola Family Business Center. We are part of the Loyola Leadership Hub at the Quinlan School of Business, Loyola University. The Loyola Family Business Center has been supporting family-owned businesses for well over 30 years. And we're really happy to bring this great content for you today. It's very typical of the kind of content that we like to provide for our members and other stakeholders who are interested in family businesses. We are really delighted to have so many people joining us today. As I said a little earlier, we will be recording this webinar and we will be posting it on our website after the fact. Before we jump in and meet our very special guest today, I have the great pleasure of introducing, let me get my slides going here, sorry guys, the wonderful Ray Whittaker, who is the head of the U.S. Diversified Industries at BMO Harris. Before we talk with Ray, I just want to sort of set the table here for what we're talking about. Before COVID hit, we often celebrated family businesses in a very public way. And we had a large event every year that was lovely and sponsored and supported by BMO for many, many years. But when COVID hit, like a lot of you, we had to regroup and figure out how were we going to do what was important in a different way. And what we came up with was this great idea of celebrating family business heroes. And it really stemmed from the fact that on a daily and weekly basis, we were hearing these really beautiful, heroic stories of family businesses working together to innovate, to find solutions for problems that emerged out of COVID, things that they were doing to support their co-workers, their employees, their communities, and then really kind of Herculean efforts when it came down to trying to meet their suppliers and customer needs. So we really wanted to tell those stories, and we were so happy because our friends at BMO and our friends at Catton stood up and said, we'd like to help you tell those stories. And that's how we started here today. The Heroes Campaign launches actually today with this webinar. And those of you who stay around long enough at the end of the webinar will get to see a little teaser video of some of the family business stories we'll be telling throughout the coming weeks with the strong and staunch support of BMO and Catton. So without further ado, Ray, welcome, welcome. It's so good to see you this morning. Can you tell us a little bit about why BMO was eager to support the Family Business Heroes campaign?
Sure, absolutely, Anne. And as you are well aware, family businesses are the cornerstone of our economy and of our bank. Importantly, these businesses are and will continue to be the catalyst of our post-pandemic recovery. And, supporting this program and supporting you and your organization was actually one of the easier decisions we had to make. So I'm delighted to be and continue to be part of this.
Thank you, Ray. That's really awesome. I know you have a very long history. We know well that you have a long history of supporting family businesses and the Family Business Center at Loyola. Can you tell us a little bit about what you hope to see for businesses as they come out of this crisis?
Yeah, it's going to be pretty clear to me what we're going to see. And it is no different than in prior downturns and periods of economic stress. It is the family business that adapt and innovate quicker than their peers. We've seen this time and time again. It's those businesses, those family businesses that provide the stable and growing employee base, as well as provide that much needed support to the communities.
Thank you, everybody, for your patience. Our next wonderful speaker is, let's see here, Michael Gregory, Deputy Chief Economist and Head of U.S. Economic, sorry, lost my notes here, and Deputy Chief Economist for BMO Harris. He and his team have generously offered to share their insights into the both current and near future economic trends. I am going to do my very best to monitor the chat. We have a lot of people here with us today. We have about 89 people, and we're going to be together for about an hour. And Michael gets to talk. Thank you very much, Michael, for about 45 minutes. But please use the chat, and I'll monitor that chat if you have questions that you'd like to pose for Michael. He's very great at sort of jumping in and answering extemporaneously. And also just know that at the end of his presentation, we will be able to answer any questions that you might have. So Michael, I'm going to stop the share and I'm going to have you share your screen.
Sounds good. Well, I'm going to do that right away here. Bear with me a second. All right, and I'm assuming you're muted now, and we see the slides, and I'll just say turn this next slide, please, and you can do that. The title of my talk today is Shaking Off COVID Shackles. Obviously, I have a very upbeat message to give today, because it does seem that the very worst of the pandemic, the most acute phase of it in terms of economic impact, is now over, and we can look forward to much more robust economic activity in the months and quarters ahead. So if you go to the first slide, please. Thank you. Well, obviously we have the economy here that is gaining momentum. We're looking for very strong economic growth through the spring and the summer months. We got 6.5% growth in the first quarter. And in fact, we think for the second and third quarter, we are probably going to average something close to double-digit growth through those 2 quarters. Again, as the economy continues to reopen. On the job side, we ended up doubling our job growth in May compared to what we had in April. But at 560,000 roughly, that was still a little bit of a disappointment. And in fact, the last couple of months, despite the fact that we've created some 800,000 jobs, that's less than what the market was really expecting, less than we were expecting. And it's beginning to sort of highlight one of the major barriers to more rapid growth in the economy right now. If you go to the next slide, please, Anne. Well, that major barrier is the fact that businesses across America are having an extremely difficult time finding workers. We will get the job openings and labor turnover survey for April. We will get those figures tomorrow. But as far as the latest figures to March, we ended up with more than 8 million jobs opening across businesses across America, both big and small. And that is the most that's ever been recorded, even as a share of total payrolls since those data began in the early part of 2000. Now, if we look at the National Federation of Independent Business, their small business survey, and those figures go back, in fact, to the early 1970s. And yet again, we're seeing record amounts of firms saying that, number one, they've got job openings that they are unable to fill. And it's almost half the firms, small businesses across the United States, and it's slightly greater than half, and are saying that the reason why we would probably be entertaining even more job openings is the fact that we are getting very few applications, or the quality of those applicants in terms of their skill set isn't measuring up to what we need. So there does seem to be a very serious problem in the economy right now with labor supply. And in fact, that seems to be the #1 governor in terms of how rapid we really grow, how fast we reopen over the months and quarters ahead. If you go to the next slide, please, Anne. All right, so what's going on in the economy, particularly on the labor markets? Well, one thing we could look at is the labor force participation rate. It measures how many people in the population are actually part of the labor force, either working or looking for work. And what we've discovered is that while that participation rate fell very sharply and during the pandemic and started to rebound, at least, it's been stuck in a range for the past several months, and doesn't seem to be breaking out of that range at all. It's still well below, at least a couple of percentage points below where we were before the pandemic. So something is happening here. People that were part of the labor force before aren't there anymore. And in fact, the government's figures that released on Friday suggested that there were some 2.8 million people that were not in the labor force. Therefore, they're not counted not counted as unemployed. that are not participating, are not engaged in the labor force. And the reasons for those are often cited: childcare considerations. While schools are increasingly open across the country, daycares as well, that's been problematic for many workers across America. Another issue too that pops up in the surveys is the safety of public transit. For many workers, public transit is the only way in which they can get to their jobs. And with not a lot of ridership and concerns about safety because of it, a lot of people are opting not to take public transit, and therefore they can't get to their former workplace. And there are other health concerns too. A number of people simply are still fearful of the pandemic and don't want to be out in the workforce just yet. But our own view is that we are going to see these things begin to sort of remedy themselves. We're getting further reopenings, and in fact, California, for example, expects to be fully reopened by June 15th. That's the sort of largest state economy. The largest city economy, New York City, expects to be fully reopened by July 1st. And in fact, President Biden has promised to sort of, or not promise, he really can't make that promise, but is gunning at least to get the US economy fully reopened by the 4th of July. And it seems well on track to doing so. So that'll go a long way in ameliorating those concerns. Another sort of big issue too is the vaccination rates continue to rise. So people are concerned about the safety issues from COVID. We'll get more those concerns to be addressed. And on top of that, the state and local governments, because of the American Rescue Plan Act, have been given $350 billion to spend on basically anything to help boost their economies. They just can't fund tax cuts, and they just can't fund contributions to their pension plans. Anything other than that is fair game, including funding transit systems, getting them cleaner, getting them safer, and in many of the big cities, perhaps dealing with homelessness as well, which is, perhaps one of the reasons contributing to some of the safety issues in public transit. So, it seems to me that over the next few months, and definitely by September, this becomes less of an impediment for people wanting to engage in the labor force. The next slide, please, Anne. Okay, but we still have more than 9 million people that are officially unemployed. And that compares to just under 6 million we had before the pandemic. So there's a lot of people who are currently, kind of looking for jobs now. And in fact, to receive unemployment benefits, some of the restrictions or some of the requirements were relaxed because of the pandemic. Basically, you had to be actively looking for work, and those were relaxed somewhat. And if anything, those are starting to be tightened up again. But clearly, there's a lot of people that are still, on the dole, that are collecting benefits, some make the argument that in certain states, at least, that the combination of state and federal benefits is more than what the minimum wage is in those states, and more than what some unskilled workers can maybe actually earn in the marketplace. And this has become a bit of an impediment for people re-engaging in the workforce. And as a result, we are seeing a number of states, actually almost half of them now, have opted to end the pull out of the federal programs earlier than their current scheduled September 6th ending. And in fact, some states, Arizona comes to mind, actually losing some of the funding they've got through the American Rescue Plan Act to actually use those to fund incentives, back to work bonuses and things like that to get people back into the labor force, something that the private sector has been doing very recently in terms of signing bonuses and things like that. So I do think both of these issues will become less of an issue going forward. If you go to the next slide, please.
Before we do, and I'm going to just ask you to mute so I can ask some of the questions that are in the chat. There's a couple of things that people are interested in. They're looking at competition for labor and steep increases in wages. People are interested in understanding how inflation is going to impact all of this. And then people are interested in like childcare accommodations. What is that going to look like? Is that going to impact people's return to work?
Sorry, can you repeat that last question again, Ann? I didn't quite hear it. I heard the one about sort of potential wage inflation. What was the other one? Sorry.
The others are impact of childcare accommodations for people coming back to work.
Mm-hmm. Okay, well, let's just start off with that wage side. Obviously, I mean, one reason one way in which we can actually accelerate this re-engagement in the labor force, which we're already starting to see is some gains on wages, and we are seeing some states and local governments and even some companies are beginning to raise their minimum wages. And in the food service and accommodation business, which tend to have sort of the lower average wages throughout the economy, we are actually seeing some upward pressure there as well. So I do think this is going to be one of the mechanisms by which we, in addition to increasing vaccination rates and reopening the economy further, and a little more money being poured into public transit, another mechanism is going to be starting to pay workers more. And if anybody's businesses that are listening, you've probably noticed that you've had to sort of do that either through direct wages or other kinds of benefits and sort of supplementary income in terms of not only retaining your workers, because of competition out there for very good workers, but also attracting new workers. And again, that last question I believe is what was going to return to work going to look like. I think one thing that is going to, I think, be a permanent fixture of the workplace is work from home is not going to be as prevalent as it was during the peak of the pandemic, but I think it's going to be a permanent fixture of the labor market and the working in America going forward. Many businesses are adopting now a kind of what we call sort of a hybrid model, realizing that most of their workers, particularly in the big urban centers, banks like ourselves, will have most of their workers back to work, but there'll be a greater flexibility and option, to have some workers always, all the time, working from home, and that will rotate a little bit, and so I do think there will be some permanent legacies in terms of how people work in the future because of the pandemic. Right. Okay. So let me just continue along here. Obviously, one of the biggest things in terms of getting the momentum in the economy is the fact that case rates in America are now at the lowest level they were since the pandemic began, and that's just great news. As you can see from the chart here, we had that two-stage first wave and that very ugly second wave. But unlike many countries in the world, the United States didn't really have much of a third wave. Got a little bit of an uptick, but was able to arrest those cases and get the total cases continue to come down. And that's simply because America is one of the more aggressive countries in terms of deploying vaccines. It has one of the world's best vaccination rates. Not only for first vaccinations, but most importantly for fully vaccinated people, and therefore, that's giving people confidence that, particularly governments, that they can continue to reopen the economy, which we are seeing. So, and that is just great news going forward, and that we believe is going to again further add to the momentum in the economy, particularly by instilling a lot more confidence, people's confidence, literally to crowd. Next slide, Anne. All right. In the meantime, it wasn't only people that are getting jabs in the arms. The economy got two major doses of fiscal stimulus to begin this year. The Consolidated Appropriations Act, which was signed by President Trump in December. Then, of course, in March, we had the American Rescue Plan Act that was signed by President Biden. And between those two pieces of legislation, we're adding some $2 trillion of extra support for the economy in the fiscal year ending September. The first 9 months of the year, that's $2 trillion, and that's providing tremendous support. Again, that momentum, which is why we're going to see double-digit growth in the economy going forward. Now, we're also seeing, the Biden administration begin to flesh out its Build Back Better agenda, including, an American Jobs Plan, American Families Plan. And then paying for that, unlike the American Rescue Plan Act, which was basically deficit finances, we printed money to pay for that. These other measures dealing with infrastructure and childcare and healthcare and education and things like that will be paid for by raising taxes on corporations and on higher income individuals. Now, we're already beginning to see a push for bipartisan support, which is critically important because the Democrats, in fact, do only have a razor-thin majority in the Senate. Is we're seeing some of the aspirations, at least of the American Job Act, being pushed back, and the taxation level, amount of taxes also been pulled back to try and organize something, get it passed on a bipartisan level. The bottom line is that Washington ain't finished yet in terms of providing support for the U.S. economy. If you go to the next slide, please.
Before I do that, I just got 2 questions from the audience about inflation in particular. Do you agree with Larry Summers' viewpoint on inflation? And also, just in general, could we talk a little bit about Congress's focus on fiscal responsibility and the federal deficit?
Sure thing. Well, I'll address the the inflation question down the road, because I do have a number of slides around that, and it's critically important. And you're right. This is a big debate now, is how transitory will all of these inflation pressures be? And there's a lot of them. I'll turn to that one and very, very quickly. But on the fiscal side, just so happens that question came up just before my next slide here. And as you can see, there's a legacy to all of this fiscal support for the economy, and even the future fiscal support, because even all of these measures in terms of infrastructure and support for daycare and healthcare and education, higher taxes are going to be paid for that. It's not one for one. They're still going to be adding to the deficit somewhat. There's a legacy to this. The legacy are $3 trillion deficits this year, and then we're heading to another sizable deficit for this year. Again, it's the biggest deficit we've had since we were paying and funding for the Second World War. But because we've had this run of big deficits, if you look at total public debt outstanding, it's actually now, for the fiscal year ending September, it will in fact top the levels we had in the couple of years after the end of the Second World War. So we have huge amount of debt. It's not going to be going down anytime soon. There's a lot of demographic pressures on debt going forward because of Medicare and Social Security and things like that. And so this is going to have to be dealt with. This is not sustainable. The only good news, if you like, or the only sort of a common news right now is our common agreement now is until the economy is stronger, we shouldn't really be addressing this. When the economy is stronger, we're going to have a huge debate in this country about how to deal with these debts over time. And let's put it this way, we know what the answer is going to be. It's going to be in some way or another, regardless if it's run by Republicans or Democrats, it's going to be higher taxes. It's going to be reduced spending, or spending that doesn't grow as rapidly as it otherwise would be. And hopefully it's going to be, a stronger growth as well. And I think that's the promise of some of this infrastructure spending. It will allow the US economy to grow at a faster rate than it otherwise would be. The next slide, please, Anne. All right, well, it's not only fiscal policy that's weighing in here too. Monetary policy has been doing its job. As we know, very early in the pandemic, we reduced interest rates to the zero lower bound, or the effective lower bound. And the Fed's been buying securities and providing loans left and right. A lot of their loan support programs have now ended, and they're winding some down. But the ones that keep going are that $120 billion a month of purchases of treasuries and MBS designed to keep lower, longer-term interest rates and mortgage rates low as they possibly can be, that stimulate the economy broadly. And the Fed has said that until it makes substantial progress in getting to maximum employment and price stability, that they will continue to buy securities, at least at this pace. Obviously, with the big, huge budget deficits that the government is running, the Fed buying, say, $80 billion of treasuries every month goes a long way in avoiding the sort of the upward pressure on treasury yields that would otherwise occur if not for the Fed's buying. If you go to the next slide, please. All right, well, all of this support for the economy has in fact, or rather support for households and household income has resulted in a spectacular phenomena where we've seen saving rates just explode higher. Obviously, with all this income support for the economy, whether it's the economic impact payments or whether it is enhanced federal benefits for the unemployed or other kinds of federal support, that kind of income support for households has actually outstripped the ability to spend, particularly, at the peaks of the first and second wave of the pandemic, we had a lot of restrictions. You simply couldn't spend because, things were closed. And on top of that, there's a segment of the population, particularly the higher wage earners, that did, in many cases, have the ability to continue working with few little speed bumps steep bumps almost uninterrupted during the pandemic. So income growth has still been pretty solid in the economy, and that's led to this huge buildup of excess savings. If we look where the saving rate would have been back in February 2020, simply extrapolate how much excess people are saving, it adds up to some $2.2 trillion of additional saving that has occurred since February of last year. And that kind of amount of spending is going to provide tremendous support for consumer spending and therefore the economy in the months and quarters ahead. Now, with respect specifically to with the economic impact payments, the New York Fed has done surveys after each round of payments, and we've just, of course, finished off with a third one, and to find out, how households how they tend to allocate those funds. And it roughly turns out to be about a third being spent, a third being invested, and a third being used to pay down debt. But if you think about the support, say through direct unemployment assistance, or the saving that's built up because you couldn't really spend, well, it seems to me even a larger portion of that is actually going to get into financing spending going forward. And there's an awful lot of spending still to be done. If you go to the next slide, please. If you think about sort of pent up demand, I mean, the area of the economy, and in fact, it's the largest part of the economy, the services side, that is where we've seen consumer spending yet to sort of catch up to where it otherwise would have been. We're hundreds of billions of dollars of spending below that level. As you can see, consumers have, even if they only spend a third of those excess savings, have more than enough money, not only to propel spending on services back to where they were before the pandemic, but also to continue to push even goods spending higher. And there's been a big concern that as we reopen the economy, people that had shifted from spending from services to goods, for example, you're buying groceries instead of eating in restaurants, you're buying sort of grown-up toys instead of going on vacation. Well, as you're able to go on vacations, or people want to, and as restaurants more fully reopen, a lot of that spending will divert back into the services, and some will. But the message I like to leave you with is there's enough money out there to keep both consumer spending on goods and services at an elevated level. If you go to the next slide, please. And I guess the other question that people often say, well, we've had this saving built up, literally the past 14 months, 15 months, how much is left over? I mean, clearly people have been investing. That's one of the reasons why stock markets are at record highs and housing markets are very strong. People have been using it to finance some of their outlays. And debt remains pretty low and in very good shape in terms of, the aggregate levels in the economy. So how much is really left over? Well, you can actually kind of look at the money supply figures and just look at all the deposits in bank accounts and other accounts of financial institutions across the country. And what you see is there's like more than $3 trillion of excess money above the trend that was happening back in February. And that's not only personal deposits, that's also business deposits as well. So not only do consumers, but also businesses have a lot of liquidity, a lot of cash. And I think we're in for several months and several quarters of very strong spending, what the Fed has referred to as a burst of spending. And the big question, as one of someone in the chat had mentioned, is what does that mean for inflation? And we're going to be talking about that very shortly. If you go to the next slide, please. Well, one area that's done particularly well is housing. Again, that's one of the area where people have decided to take some of their payments and invest, a little extra in paying down debt or at least making their balance sheets in better shape. But also the fact that many people have been able to save a lot more, it's allowed them to sort of reach that down payment threshold. And as a result, we've seen housing activity really begin to take off. It's not as robust as it was, say, several months ago, but with record low levels of homes available for sale, we know what happens if demand even just remains pretty solid, is that's going to lead to more home construction, more construction jobs. And as we know, it's a relatively small part of the economy, but it has very sort of long tentacles that reach out in everything from, purchases of appliances and furnishings to sort of home renovation activity. If you go to the next slide, please. It is the case, though, that, part of the huge wave we've had in demand for housing, that initial wave that occurred immediately in the months and quarters at the start of the pandemic, people looking, because of work from home, looking for bigger homes to live in, or bigger dwellings, having less dense dwellings. So maybe looking for single family homes instead of sort of multifamily residences. And of course, basically moving from the urban cores into sort of the suburbs and the exurbs and even the rural areas. And some of the hottest real estate markets over the last little while have been those that, are just barely beyond commuting distance from some of the major metropolitan areas across the country. And obviously one of the reasons why the housing market has kind of just cooled off just a little bit in terms of activity is because a lot of that initial wave has actually occurred. But we do believe that housing demand will remain pretty solid. For its mortgage rates remain historically very low. I mean, they moved up from their ultimate lows, but when I bought my first house, mortgage rates were 12%, and a lot of people kind of forget, that they used to be that high. So you see a 3% or something under 4% in terms of a 30-year fixed rate mortgage. You go, wow, that's still a very attractive rate historically. Also, the millennial generation, which was slowly getting into sort of those home ownership years. For those that had intentions to buy a home in 1 or 2 or 3 years, what we're beginning to see is a lot of those plans being accelerated or being pulled forward. A classic example of fear of missing out, because we all know that if housing remains pretty solid as it is and home prices continue to advance, we could see home prices 10, 20% higher in 2 or 3 years' time. And as a result, if you're going to buy, if you intend on buying, better to buy sooner rather than later. And it's important thing to keep in mind that now that the pandemic is kind of over, we're beginning to see the very affordable urban areas even rebound as well. And as a result, we do think housing is going to be a very important part of the momentum of the economy, along with consumer spending, over the next several quarters. If you go to the next slide, please. Well, all that activity in housing, we know it's happening. It's created this huge spike in home prices. We haven't seen this kind of home price inflation since like 2005, which of course automatically sent shivers down the spines of a lot of people out there, because that was the kind of the bubble we had back then. It led to the global financial crisis. It led to the Great Recession. But the important thing to keep in mind now is there's a lot less leverage now going on, and there's a lot more prudence in lending that was the case even back in 2005. And as a result, we believe that this is a boom in housing that will just correct itself. At some point, housing gets a bit too expensive, and that sort of slows demand. Maybe that's actually happening a little bit right now. But what we're seeing now is a classic, not an imbalance created by excess debt. It's an imbalance created by a limited supply with a lot of strong demand. And the result of that is prices go up, and eventually demand cools as prices get a little too high. But of course, that higher prices are a signal for more people to build more houses, which is what we're seeing. So again, housing activity, a very strong part of the recovery going forward. Next slide, please, Anne. All right, so another part of the puzzle here is on business investment. Now, that's been more of a mixed bag. I mentioned before, or showed you that businesses also have a lot of cash sitting around waiting to be deployed in more investment, probably more machinery, equipment, and intellectual property than, say, building new factories for the time being, but also to hire more. And what we're beginning to see is that sort of rebound in those two parts of business investment, the machinery side and the technology side. And in fact, if anything, the fact that many businesses are now facing labor shortages and think that, back in 2018 and 2019, that was very much the major issue as well for many businesses. And we saw back in, again, it's 2017, but more or less 2018, 2019, particularly 2018, this pickup in business investment and increased amounts of automation to deal with the lack of availability of labor. And we're likely going to see that same kind of theme going forward. The weakness on the structure side of investment is very much tied to the oil sector. Oil prices are getting pretty high again. We're seeing them $70 a barrel this morning, but levels of activity, the actual production, remains still well below where they were, some 2 million barrels a day below the pre-pandemic levels. And that's keeping a lot of investment in that sector at bay for the time being. If you go to the next slide, please. All right, so we've got to step back just a little bit further here and realize that this was a pandemic, which means it affected a lot of countries at the same time. And the important thing to keep in mind is that to various degrees, depending on what vaccination rates are like, depending on how much stimulus has been provided in terms of support, either from monetary policy or fiscal policy, all countries are rebounding quite strongly. And so the global economy is going to do much better. And because of that, U.S. exports are going to have a better sort of a growing market going forward. And there are a lot of other things I think that favor more exports by American companies. Go to the next slide, please, Anne. One of those is the fact that the US dollar, we believe, is going to continue to weaken. Good if you're an exporter, not so great if you're an importer. If you're importing, of course, in foreign currencies, if you're transacting in US dollars, it's not that bit of a problem. We saw the US dollar earlier this year begin to sort of appreciate after falling from record levels. And of course, those record highs were hit at the peak of panic around the pandemic. And it's been steadily declining since. But once we had signs of the massive amount of fiscal stimulus that I started talking earlier about, and also the fact that bond yields were rising in the United States and were much higher than in many other countries, that created a lot of capital inflows into the US economy that kind of pushed up the US dollar for a little while. But we started to head back down because the main driver of the currency, quite frankly, is what's happening in the global economy, what's happening in terms of global investors' perceptions of risks, and all of those are improving. So people are moving away from the US dollar and looking at emerging markets. They're looking at commodities. They're looking at a lot of other things, which tend to weaken the US dollar. And we think that's going to continue. Plus, from a fundamental standpoint, for some of you economics in college, countries that run record-sized trade deficit, which we have, and a record-sized budget deficit, which we have, tend to see their currencies weaken over time. I do think there's also some other encouragements for exports going forward in terms of the US-China trade deal, which was penned literally the month before the pandemic exploded. And obviously, China's not lived up to its commitments because we did have a pandemic, but they seem committed. And I think the administration is going to hold them to buying those extra $200 billion of imports that they promised as part of that trade deal. We have the Usmca, which quietly became into force back in July 1st of last year. We're in the middle of a pandemic, didn't really have much of a fanfare, but it is a win-win for the US economy too, particularly for auto parts sector, agriculture, things like that. But also I think more favorable for exports is just the trade policy environment is a little more certain than was the case in the previous administration. Case in point, instead of tit for tat tariffs between the United States and Europe, which were scheduled to go in place this month, what we're doing is we're talking. And so Harley Davidson motorcycles and Jack Daniel's whiskey is not going to cost more expensive in Europe for the time being, which should ordinarily help those markets or help those products more than otherwise would be the case. Next slide, Ann. All right, so we add up all of these things together. Very strong consumer spending supported by an unleashing of pent-up demand. We've got good, solid, booming housing markets going to continue. We've got business investment, but not so much on the structure side, but definitely machinery, equipment, and software and other intellectual property, and solid export performance. All these things add up to very strong overall economic activity. And again, we're looking for the next couple of quarters to average close to a double-digit annualized rate before sort of cooling off a little bit. We're looking for like 7% on average for this year, very strong growth. And in fact, we think we will make up all of the GDP we lost during the recession in the current quarter, we're in right now, the second quarter. And however, we all know that not every parts of the economy are growing, at that pace. Some are doing better, some are doing worse, what some people refer to as this K-shaped recovery. And if you go to the next slide, now, we don't have a lot of up-to-date data what industries are growing, performing. We only have it to the fourth quarter of last year. Very shortly, we will have first full quarter figures, and we know things have only gotten better since then. But from what we saw from the first quarter, we know there are definitely winners and losers in terms of economic activity, in terms of who's doing better than expected, who's doing worse than expected. The ones that are doing expected, not surprising, better than expected. Any activities that had an outdoor element to them, agriculture, construction is done well. Construction was deemed essential. sector in many states during the worst of the pandemic. Things that can adequately be done sort of at home, management of companies and enterprises, the financial services, again, have boomed back. And it's also helped. We have a booming housing market, booming stock markets, and of course, information sector. If anything, the technological change was accelerated because of the pandemic, and it's boomed for them. And of course, we've also seen a huge demand for goods and as opposed to services, which of course has led to very strong manufacturing activity. But on the other side of the ledger, anything that's involving sort of crowds, whether it's education, whether it is food services and accommodation, arts, entertainment, recreation, they continue to lag behind. And this is where a lot of the jobs are still yet to have fully returned. But these are the areas of the economy that are going to accelerate here as we continue to reopen. Just think about it, with the entire US economy more or less fully open as of July 4th, the third quarter for some of these sectors are going to be very strong as people go back to the restaurants, they go back to the concerts, and they go back to the sports arenas. And I'm just mentioning, you can see from this chart that oil and gas sector again is lagging behind, and again with production still well below where it was before the pandemic. You go to the next slide, please.
Before we do, Michael, I just have one question from the audience. Somebody wants to know, where does healthcare land in this picture? Leading, lagging, what's the future look like for healthcare as an industry?
Great. Well, obviously, healthcare are one of the ones that's sort of in the middle of the pack, kind of following kind of the national average. It had lagged a little bit more during the pandemic for the simple reason that a lot of people canceled appointments and people, weren't doing, non-essential medical activity. Now we're kind of in catch-up mode, and I know a lot of doctors do worry about, this period we've had, a year and a half where, people may not have attended to their own personal health care as well as they otherwise could. And therefore there may be sort of consequences of that in terms of higher disease rates and things like that. But apart from that, I do think that what's really going to be driving healthcare, we're going to see more money coming in or support from the federal government for that going forward. But also I think the demographics do point to, increased activity in that sector. So if you think about sort of jobs going forward and what areas of the economy are going to be leading, I do think healthcare is going to be one of those that are going to be sort of leading the pack over time. Once the economy is back fully recovered across all sectors as well. All right, so we've got this economic recovery again, fully recovered in terms of GDP by the second quarter of this year, the quarter we're in right now. We all know that we still have some, 7 million jobs still not yet recovered from the kind of payrolls we had just before the pandemic. And therefore it's gonna take a little bit longer, even at sort of 500,000 a month, 7 million jobs is like 14 months of recovery. And therefore we do expect by around the middle of next year that we will get all of the jobs recovered that were lost during because of the pandemic. But whether you look at the the establishment survey, the payrolls, or the household survey, and the unemployment rate will, by the second half of next year, and more importantly towards the end of next year, will be back to where we were just before the pandemic, back to 3.5% with which was a 50-year low at the time. And the important thing to keep in mind that is actually below the kind of level you would expect the unemployment rate to hover over the long haul. The Fed, and we believe that's roughly around 4%. So we're going to have, what we would call tight labor markets persisting for some time. And that's an outcome that the Fed very much wants to get back to where we were before. Because for the couple of years we had before the pandemic, we had very low unemployment rates with very little signs of inflationary pressures building. But what we did see was a social broadening of job gains and a social broadening of wage gains. And that's the kind of environment that I think the Fed and policymakers really want to get us back to. And hence the Fed's even changed its mandate, thinking of sort of maximum employment in terms of, how close they are to that sort of longer run 4%, but rather, is everybody who wants to work, do they have a job? And I think, that's a little bit of different orientation than the Feds had before. If you go to the next slide, please. Okay, so here we're going to finish off the last topic here, and the question was made earlier, Anne, in terms of inflation. Now, the image here on this chart is a measure of expected inflation that we extract from the TIPS market, the inflation protection securities that the Treasury sells. And as you can see, that spiked up quite a bit. So the market is expecting higher inflation, to persist over the next several years. And increasingly, consumers are beginning to think that way too. And there seems to be a bit of a perfect storm aligning here with respect to inflation. Number one, and you've heard a lot about these things so-called base effects. Back in April of 2020, we ended up with the largest drop in prices in history. Again, because of the pandemic, people couldn't go in restaurants. So guess what? Restaurant prices fell a lot. Things like that. And now we're sort of comparing now where prices are beginning to go up again to when they were falling. So on a year-over-year basis, it looks like a big spike. Plus, a lot of goods were down, stayed down in price. We're beginning to see that kind of accelerate. Ticket prices for events, for example, are going up very quickly now, as more and more people are getting out on entertainment and sporting events. The other thing that's affecting sort of the inflation dynamic here are supply shortages and other capacity constraints. You can see that sort of pop up, for example, on used vehicle prices. Because of a shortage of chips that go into automotive production, there's a less of a flow of new cars coming onto the market. Therefore, people who want new cars are turning some of their demand to the used car segment. That's putting more demand into the used car segment and putting upward pressure on used car prices. And another factor, and we all see it when we go to the grocery store, higher food prices, higher gasoline prices, other commodity prices are going up. And amid all of these sort of, arguably they could be temporary, or they could, or maybe a little bit longer than that, but are occurring with this burst of spending, currently happening and going to continue to happen over the next several months and quarters. And so there's a really big worry out there about the potential for inflation. Now, inflation is going up. If you go to the next slide, please. But ultimately, the worry about inflation is whether or not we are seeing what economists would call compensating wage gains. Let me sort of step back and explain sort of why the Fed at least believes that this increase in prices we're seeing, we have core inflation above 3% or 3%. We have headline inflation, above 4%, and that core inflation rate we haven't seen for CPI, since the mid 1990s, and that headline inflation rate of 4% plus we haven't seen since just before the Great Recession, when oil prices were $100 a barrel. So clearly, things have gone up. But things will eventually cool off unless we have compensating wage gains. And the rationale there is higher prices, erode purchasing power, just like in the housing market. The housing market's cooling down because prices are going off and people just can't afford it anymore. Well, the same thing with prices. Prices go up. People maybe pay for it for a little while, but at some point their purchasing power goes down, demand goes down, or at least slows. At the same time, the higher prices signal more supply. Next thing you know, things are back at more of an equilibrium, and the pressures we were seeing begin to subside. Well, there are two issues there about that dynamic that worry us, that maybe it was expected to last a few months or a few quarters could last a little bit longer than that. And particularly, it's with respect to whether or not all these drawdowns and savings that we are going to see can compensate or act as a surrogate for wage gains. And as a result, people are willing to pay more for a little while because they've got the cash to do so. And all of a sudden, what was expected to slow because of higher prices doesn't slow in terms of demand very much. So the pressures continue to sort of propagate. And at the same time, on the wage side, while a lot of the broad measures of wage inflation really don't show any signs of heating up much at all, you notice that average hourly earnings have been quite jumpy. And it accelerated a lot during the early part of the pandemic. And it's largely because of the makeup of the job losses. A lot of them were the lower income jobs in the arts, entertainment, and the food service accommodation area. of the economy, they tend, particularly on the food service accommodation side, tend to have lower wages. And as those people lost their jobs, the average went up everywhere else. So it looked like the average wage gain was going up when it's purely just from a mix of the employment. And now that those jobs are coming back, it looks like there's downward pressure on wages. But in fact, as we know, if you actually look at a food services and accommodation, their own wages, which are arguably are the lowest. We just saw the average wage rate go up about $15 an hour for the first time ever. So there's pressure there, even though that is still well below the national average in terms of what average wages are. But we are beginning to see more and more pressure on that front. So as those wages go up, does that allow, give people a little more resources so they continue to pay higher prices for a little while? And this is the worry. That was the motivation, I think, for that question. Are we beginning to see inflation unravel? We haven't seen inflation being a persistent problem, at the core level, at least, excluding food and energy, since the mid-1990s. So are we back there again? Go to the next slide, please. We happen to think we will end up, when the dust settles from all these temporary increases, a higher run rate for inflation. We do think that. We do think we're going to be in an era where core inflation is going to settle in somewhere between 2.25% and 2.5%. It was well under 2% before. And by the way, that's exactly what the Fed's trying to achieve here. Inflation running modestly above 2%. And so the question is, if this thing is going to accelerate, and then it's going to, when it settles down, it's going to be running at a higher run rate, why wouldn't it be even higher? Well, part of that is the fact, though, yes, labor markets, there's some shortages out there, but when you adjust for, people that are not in the labor force right now, there's still quite a bit of slack. The unemployment rate or the underemployment rate, for example, is still quite high. So that's going to act as a little bit of a damper on broad wage inflation. But more important than that, some of the secular forces or long-term forces of disinflation, like technological change, which, by the way, was accelerated because of the pandemic, demographics, we are aging as a society, and that tends to put downward pressure on inflation. Just got to look at Japan as the vanguard, if you'd like, or of that problem. And of course, globalization also is inherently disinflationary. Arguably, you can make a case that because of the pandemic and because of the global trade war, which quite frankly is still in place before the pandemic, maybe a lot of companies are rethinking how they think about globalization. I think that bodes well for some reshoring to North America of some sort of supply chains. But the fact of the matter is that globalization is still a force to be reckoned with, inherently on balance disinflationary. So we do think this will act as a sort of checks on a more rapid acceleration. But there's no question that is where the risks lie. Go to the next slide, please. All right. So I mentioned before, the Fed has already kind of changed its, how it's thinking about the unemployment rate. They've said, listen, we aren't, unlike every other cycle we've had since the Second World War, just because the labor market tightens, we aren't going to start to tighten or raise rates preemptively, because we don't think necessarily a tight labor market leads to higher inflation the same way it did before. Something has changed in the labor market. At least they think that's the case, and they have evidence from before the pandemic, which kind of supports that view. And at the same time, because we've had this long run of a core inflation running below the Fed's 2% target, they said, we want to make sure people believe in 2. So we're going to run slightly above 2 for a while so that it averages 2% over time. So maybe over a 2 or 3 year period, they're shooting to get inflation at 2, which means we got to run a little bit higher for a little while, which is exactly we think it's going to happen. It's interesting, at the last sort of survey that the Fed did of themselves in terms of what they expect, very few or the minority of Fed officials had penciled in a rate hike by the end of 2023. I mean, the majority of Fed officials, at least back in March, believed the first time they would raise rates would be 2024. I think when we get the new Fed survey, which will be out next week, when we get the policy announcement, that we will see actually a rate hike starting to be factored into 2023. In part, as these pressures we're seeing and the risk that they could be more persistent, and the fact that the vaccinations and the policy support are providing tremendous growth for the economy, that will likely lead to interest rates going up a little bit sooner than what the Fed expected. Next slide, please. All right, and so we're not expecting anything for the next couple of years, but we in fact are expecting the Fed to begin raising rates in the early part of 2023. Doing so very slowly, a couple rate hikes a year, so nothing really to sort of worry about. There is a risk that those could be delayed and they could be more compacted in terms of the increases. Recall the last cycle we were kind of moving at least at one point almost every quarter, but and in some cases the previous cycle before that it was every meeting. But we do think that the days of those kind of very rapid acceleration, probably rapid increases, are behind us. On the long-term interest rate side, we do think most of the big jump we've seen will stick. And we'll get more gradual gains going forward as we begin to see some of these inflation pressures persist, that they aren't turn out to be temporary, and more importantly, as these big budget deficits continue, when investors are not looking to buying treasuries as aggressively, they're looking again at commodities, emerging markets, other assets, things like that. Okay, next slide, please. All right, so we got a great outlook for the economy here. It's going to be very strong. If you see something in the store you want, you better buy it sooner rather than later, because I do think demand is going to be very strong. The pandemic continues to pose a major risk for the economy, but in the United States, at least, the vaccination rates have gotten to a point where those risks continue to fall. And therefore, hence we're getting all the reopenings, even in some of the more cautious states. Another big risk of how even stronger growth may get was how much of the Biden administration's Build Back Better agenda do we actually see unfold? We're going to clearly get some infrastructure spending going forward. And of course, the other major risk for us is if the Fed has to tighten rates a little bit sooner than what even we're thinking, because of inflation pressures. The rest of the risks for the outlook are the sort of the normal, usual risks we have. But I'm going to leave it at that for now, Anne, in case we have any more questions, because I know we're slowly running out of time here.
Sorry, Michael. I was talking and nobody was hearing me because I was muted, of course. We had a ton of chatter in the chat. In the chat. So I'm just going to use this time, if it's okay with you, to just go back to some of these questions to see if you'd like to address them. One of them I thought was interesting is, what do we know about the distribution of excess savings among consumers? It seems likely that those who are in remote white-collar jobs who have stayed employed may have a disproportionate share of such savings versus other type of workers, and those who are still unemployed or underemployed. Do we know what percentage of all the consumers is that?
Yeah, that's a great question, actually. When you think about consumers, you think about it sort of in an aggregate sense. But as we know, that when you get down into the various income segments, that distribution of excess saving is not as sort of equitable. It's not as smooth throughout those income cohorts. What you are seeing is for the lower wage or lower income households that their economic impact payments, they probably end up spending all of it just to make ends meet. And again, this is where unfortunately a lot of the job losses sort of fell in those lower income, lower wage segments. And so yes. A lot of those savings have amassed for people that were able to continue working through the pandemic, and they are whether it is construction workers or whether it is white collar workers that were able more readily to be able to work from home. So yes, if anything, one of the legacies of the pandemic is probably going to be a little greater income inequality, which is an issue. Which is why I do think that policymakers are going to look very, very hard here to make sure that we do get all of those jobs back before rates move up. I get a lot of questions about, well, is the Fed going to be why do they sound like they're going to be so accommodative, so dovish? I'm not going to raise rates for a long time. It's because even though interest rates aren't the most direct tool for dealing with labor market outcomes, they want to contribute to those labor market outcomes. So fiscal policy directed to that, the American Jobs Act, for example, as well as monetary policy contributing to that. But there's no question that we're in a situation here where in that K-shaped recovery, it's not only about sectors, it's about families too. And therefore, there's going to be a segment of the population that's going to continue to need support long after most American families are back to where they were before.
Thank you, Michael. I'm going to ask Steve Zirkle to unmute himself. He's got a question for you.
Michael, wonderful discussion. I appreciate it. So my question is really based upon something you said, which is really, this is a short-term blip where, asset utilization globally is still not at its maximum, still underutilized. So we have the short-term blip. So if you were a corporation or a company or family business, adding capacity may not be appropriate right now. Holding pricing may be appropriate, and then driving further automation into your facilities would be an appropriate use of funds, given this might be a short-term economic blip with respect to supply and demand and the labor shortage. So I'd like your view on that.
Yeah, Steve, I think you hit it just on the nail, and that's exactly, I think, the appropriate strategy now, which is why I do think we're not going to see a lot of additional capacity until we start to butt up against that capacity, and that's what makes this such an odd time. Like we're kind of feeling the pressures even in the labor markets and other kinds of product markets, supply shortage and things like that we normally feel late in the cycle, not early in a recovery. So that gives you a sense that there's some, global supply chains are being disrupted, and that will go away. The only thing we don't know is how long does that last. And as a result, I do think, for example, using technology more machinery equipment to increase automation, not only is that a shorter term fix, but it's also clearly going to be, part of a longer term solution as well, because, the world has really automated, or the trend towards automation was accelerated, literally because of the pandemic, all technological deployment. So I do think, that's probably where your shorter term strategy and your longer term strategy align, and which is why I do think that part of the economy also will be doing very well and will be leading growth going forward.
Thank you. Thanks, Sam.
Thank you.
Thank you for that. Another good question is, what is the likely increase on both corporate and individual wealth taxes? What is that going to do to the economy?
The corporate it's a wealth factor. Well, I mean, there is a lot of liquidity out there, and obviously the just like it's skewed towards sort of higher income, higher wage individual families or households on the household income side. It's kind of the same thing on the corporate income side too. Certain by sector, certain sectors are really underperformed and are stressed, and there's only so long that we can actually provide that support. Now, I'll put it this way: a lot of these sort of support measures, will be at the corporate side, the business side, they will be unwinding as the summer unfolds. Even the ones for unemployment support at the federal level, they end on September 6th. Or all of them will be over by September 6th. And there will be some people and some companies out there that will still need that support. And therefore, how governments deal with that is going to be critically important. There always is in a recession, sadly, people, that lose their jobs more persistently, businesses that go out of business, and we've seen a lot, but we're also seeing record amounts of new business formation too. So the dynamism is there, but there will be some legacies, there will be some minimal scarring. And that is something where, governments, are going to have to look at in the sense that this was no fault of the business. This was no fault of the individuals and the families. This was a global pandemic. And so I do think while support will be a lot lower, even by the end of this year, there will be a legacy, I think, of support and programs, education, things like that, for people and businesses until we've really, truly, fully recovered.
Thank you for that. Here's another one. What argument would you make for infrastructure spending? Or would you make an argument for it?
Absolutely. I mean, it's funny. There's very little that Washington agrees on. I mean, the GOP and the Democrats, but where they all agree on one thing. Economists all agree on one thing. We need infrastructure. All right. We need not only sort of bridges and roads and better tunnels, but we need digital infrastructure too. The world is changing. We got to be, on the forefront. If we're going to compete against China and other countries, we got to be on the same par in terms of not only physical infrastructure, but virtual infrastructure too. So absolutely, it's critically important. Some would say that we're roughly, and you look at various surveys, we're at least $1 trillion below where we should be in terms of public infrastructure. And so not surprisingly, that's the kind of number that's kind of bandied around a lot. Now, this current infrastructure program, or the American Jobs Act, probably end up being a lot smaller than was envisioned originally, for the simple reason, they really want to get this thing in a bipartisan way, because it may not pass if it's not bipartisan. Several, more moderate Democrats are saying, listen, I'm not going to support this unless it's bipartisan. So it's got to be bipartisan. But where everyone disagrees, economists, politicians, is how to pay for that. All right. And you have to pay for it through taxes. Now, fortunately, it looks like there's a common agreement out there. The administration has agreed to a minimum global tax of 15%, which is going to bring in some dough. But the bottom line is that who should pay for the infrastructure? The argument is that businesses are going to benefit from this. Therefore, businesses should own up a little bit more. Maybe they will, maybe not as much as envisioned originally by the Biden administration. But that's where you get the big divisions. Who pays for this? Everyone agrees we need it. The question is who pays for it. But I do think that we will probably get, before the end of this year, an infrastructure bill paid through, partly at least, through higher taxes on businesses. So I think business taxes, corporate taxes, are going to go up, but maybe not as much as envisioned in the original thinking of the Biden administration.
This was great. Thank you so much. I think we could probably sit here and keep you on the line for another, 15, 20 minutes, maybe an hour. But I know your time is valuable, and we really appreciate everything that you shared. We also appreciate everybody who contributed in the chat and questions. I want to just remind everybody that we will be posting the recording of this on our website, and then we're also going to be sending slides out to individuals who've registered for this. Now I'm going to ask you, first of all, everybody, let's give Michael a big round of applause. Thank you very much. And then I'm going to try something, and please bear with me. I want to show you something that we're really excited about, that BMO was instrumental in making happen for us, which is our little teaser trailer for our Family Business Heroes campaign. So one moment, let's see if I can do this. And if I can't, I'm going to send it all out to you. It looks like my video went away. Very sorry. You know what? Best laid plans. I'm going to send this out to each one of you after the program here today, so you can enjoy what's coming and get excited, as we are, for 12 different family business stories that will be coming your way over the course of the next 6 weeks. Thank you all for your time together today. We really appreciate the support of Michael Gregory and BMO Harris, and I hope you have a great week. Thank you.